Hey, what's going on? Clever investors, Cody Sperber back again, and today I got something that's better than finding a $20 bill in your old jeans. Tax hacks that could get your bill down to zero. Yeah, you heard me. Pay close attention. You're going to want to take some notes. Now, before I drop these financial truth bombs on yo ass, you're going to want to make sure that you just smash that subscribe button and ring that bell so that way your future self will thank you in the future. Deal? Okay. Tax tip number 1, understanding depreciation. Depreciation. The IRS's gift that keeps on giving. It's like herpes, but for tax benefits. Like Albert Einstein once said, the most powerful force in the universe is compound interest. Well, if Albert Einstein was an actual real estate guy, he'd probably say it's depreciation. Now, depreciation allows you to write off the value of a building or improvements of a building over a predetermined period of time, typically 27 and a half years for residential properties and 39 years for commercial properties. So suppose you purchase a residential property for $300,000, with the building accounting for $250,000 and the land that sits underneath it that's worth about $50,000. You can depreciate the building value over 27 and a half years, giving you an annual depreciation deduction of about $9,091. This could offset your rental income produced by the rental property, potentially reducing your overall tax liability. And real quick, before we move on, one last tip when it comes to commercial property depreciation. There's something out there called a cost segregation study or cost segregation. It's basically you breaking your property down into like small components like doors and windows and carpets. This is done through a cost segregation study. So you buy a commercial building and then you break it down through this cost segregation study. And once you've done this, you can now accelerate the depreciation that you could have took over the whole 39 years into like the first few years and accelerate that depreciation down faster. If I was you, I would definitely look into the benefits of cost segregation if you're purchasing your first commercial property. All right, tip number 2 is understanding 1031 exchanges. Now, have you ever wished you could sell your property, make a killing, and then just ghost the IRS? Well, that's what a 1031 exchange is. It lets you defer those pesky capital gains taxes. It's not magic, it's just being clever. Now, 1031 exchange allows you to defer capital gains taxes by reinvesting the proceeds from the sale of one property into the purchase of another like-kind property. So for example, it's going to work like this. Let's say you sell property A for $600,000, which you originally bought for $400,000. Instead of paying capital gains taxes on the $200,000 profit that you just made or that gain, you're going to invest that gain and you're going to roll it forward into property number B through what's called a 1031 exchange. You're going to defer all of those capital gains taxes until eventually you sell property B. Or you just keep 1031ing up to bigger and better properties and just build lifetime wealth through 1031 exchanges. All right, tip number 3 is understanding leverage. Leveraging is not just for medieval catapults. Leveraging in real estate involves taking out a mortgage to purchase a property. The interest that you pay on your payments towards your mortgage is often tax deductible. So let's say you buy a $1 million property and you put $200,000 down and you take out an $800,000 mortgage. The interest payments on that mortgage could serve as tax deductions, potentially reducing your tax burden. Tip number 4 is tax deductible expenses. Expenses, my friends, are the garlic to your tax vampires. From maintenance to management fees to utilities, these little guys can suck the life right out of your taxable income. I'm going to go ahead and do that one back. I almost had it. Taxable income. Taxable income. Tip number 4 is understanding tax deductible expenses. Expenses, my friends, are the garlic to your tax vampire. From maintenance to management fees to utilities, these little guys can suck the life out of your taxable income. So let's say you spend $20,000 in a year on property maintenance, management fees, and other operating expenses. The costs of these expenses are deductible off of your taxable earned income, thus reducing your tax liability. This is why keeping clean, accurate records for each of your rental properties is an absolute must so you can write off as much as humanly possible. Tip number 5 is all about operating through legal entities. You ever heard the saying, work smarter, not harder? Well, operating through an LLC or a corporation is working S-M-A-R-T, smart. You know what else is smart? Hitting that little subscribe button right now. Come on, smarty pants, you know what to do. Smash that button, hit the little bell. Creating a legal entity like an LLC or corporation can offer additional ways for you to reduce your taxable income. In some cases, you might be able to actually take advantage of a lower corporate tax rate. The entity itself, you can also write off expenses and even pay yourself a salary, which can help and be a tax benefit. Now, if you made it this far in the training video, I want to give you something of actual real value, not just information. It's my tax saving system download. It's yours absolutely free. Just go to www.realestatetaxbenefits.com. It's realestatetaxbenefits.com, or I'll put a link down in the description down below. Grab yourself a copy. It's going to take all the topics we're discussing here in this video, expand on them, plus hook you up with one of my best connections to make sure that you are avoiding paying unnecessary taxes and maybe even eliminating them altogether. All right, tip number 6 is understanding capital loss carryover. Okay, listen up. Just like how Batman turned his fear of bats into a superpower, you could turn your losses into gains through a capital loss carryover. It's like a save for later coupon for your taxes. Said another way, if your expenses exceed your income, so your expenses are up here, your income's down here, you can actually carry forward the losses to offset future gains. So for example, your rental property runs at a $10,000 loss for the entire year. You can carry forward that loss to offset rental income in future years, reducing your future tax liability. Tip number 7 is becoming and understanding the real estate professional status. Now, if you're like me and real estate is not, a side gig, it's the whole damn show, then real estate professional status can be a major game changer for you. The IRS has some rules that you need to follow in order to qualify to become a real estate professional, just like being more than part-time as an agent or an investor or a developer. And your accountant's going to be able to help you qualify. But once you qualify, you can now write off rental real estate losses against other types of income, even income outside of real estate. So for example, let's say like me, I own multiple business, both in development and in real estate and in education and in supplements and network marketing and all this other stuff. So let's just say, for example, you spend more than half your time working in your real estate business. Okay, you're following this channel, you're working the business, and you qualify for the IRS criteria to be a real estate professional. You can now deduct, let's say, $15,000 in rental income losses against your income from your online business or other income producing activities. Because you're a real estate professional, you can do that and reduce your overall tax burden. All right, tip number 8 is renting your own properties to yourself. I do this all the time. Renting property to your own business can shift your income from one business entity to a more tax efficient entity. Now, I've been doing this for a decade now. I go and I buy a commercial property, just like the one I'm in right now. I go and I buy this commercial property, I move my businesses or my business into the space. Then my companies rent the space at fair market value from myself, and that rental income can now be offset by depreciation and expenses, reducing my overall tax liability. I'm simply shifting it out of my company over into my legal entity that owns the rental property. You get what I'm saying? All right, let's move on to tip number 9, which is understanding tax-free refinancing. Now, when you refinance a property and you take cash out, that cash that you pull out is generally tax-free. However, it is going to increase your loan amount, so future gains may be subject to higher taxes unless another strategy like a 1031 exchange is used. But it would work like this. Let's say you own a property valued at $500,000 and it only has a $200,000 mortgage on it. You refinance up to a $400,000 mortgage, pulling out $200,000 in cash. That money is generally not subject to immediate taxation and can now be used to go out and buy another property. And as long as in the future, when you decide to sell, you use a 1031 exchange like we talked about earlier, you're gonna now be allowed to roll your money forward tax-free, building long-term generational wealth. Hey, real quick, don't forget to grab your free tax saving system. This is my gift to you. Just grab it at realestatetaxbenefits.com. All right, tip number 10, baby, solar energy credits. Installing solar energy panels or other renewable energy solutions might make you eligible for a tax credit. So let's say you spend $30,000 installing solar panels on a brand new rental property. You might be eligible for a 26% federal tax credit, reducing your overall tax bill by $7,800. A reputable solar company can explain all this in more detail, but it's a simple way to save money on your electricity bill and get a nice little tax credit at the same time. And who doesn't like to double dip? I know I do.
You dip the way you want to dip. I'll dip the way I want to dip. Give me the chip! Hey.
It's about good enough for now. Let's move on to tip number 11, which is understanding opportunity zones. Investing in opportunity zones can offer significant tax advantages, such as deferred and potentially reduced capital gains taxes. Opportunity zones, come on, Sperber, get your head on. Opportunity zones are predetermined areas where the government wants you to do redevelopment. So they offer deferred or reduced capital gains taxes. So let's say, for example, you invest $200,000 of your capital gains from the sale of one property into an opportunity zone fund. All right. You hold that investment for 10 years. And then in the future, you sell it. So you bought it for $200,000 and you sell it for $400,000. You could potentially pay no capital gains taxes on the new $200,000 worth of profit that you just created. Opportunity zones are pretty cool because you're helping people and benefiting from a tax perspective at the same time. All right, ladies and gentlemen, that's a wrap. Good job, clever investors, for making it this far in the video. If you did, smash that like button and drop a comment down below because you're a winner. These 11 tax hacks. You're well on your way to becoming a tax genius. Benjamin Franklin once said, "Nothing is certain except for death and taxes." But he never met a clever investor like you, did he? Till next time, this is Cody Sperber. I'm signing off for now. Take care. Comb your hair. Peace.